Buongiorno a tutti anche da parte mia, sono Andrea Cabrini, ma qui ci siamo trovati già diverse volte negli anni scorsi. Penso che non ci siano grandi bisogni di presentazioni. Per me è sempre un piacere essere qui, anche perché di fatto io non ho la responsabilità di gestire i soldi di nessuno, quindi posso fare le pulci ai gestori anno per anno, quando sono andati bene, quando sono andati meno bene, con una certa leggerezza di spirito. In realtà quello che è stato descritto questa mattina, cioè l'andamento del 2016, è il tema che nella nostra cronaca Classe NBC Milano Finanza è al centro tutti i giorni della nostra attività. Perché? Perché dall'inizio dell'anno c'è una grande riflessione in corso su quelli che potrebbero essere gli elementi di discontinuità, alcuni li avete visti rispetto al 2016 quest'anno, e quindi il passaggio dai tassi negativi ai tassi in rialzo, dalla deflazione all'inflazione, dalla globalizzazione al protezionismo, da uno scenario in cui si parlava solo di stagnazione secolare a uno in cui si parla di ripresa ciclica. E d'altro canto c'è chi comunque continua a pensare che alcuni elementi del 2016 potrebbero tornare. Pensate al rischio politico e al fatto che alcuni momenti dell'anno potrebbero innescare quei momenti che sono stati descritti, che sono quelli in cui tutti si muovono nella stessa direzione, quindi riuscire a selezionare è più difficile. Allora, come leggere, come i gestori di Hedge Invest leggeranno quest'anno, e quello a cui ci dedichiamo adesso, è il primo con cui parliamo, è Marc Chapman. Marc Chapman è il gestore di Principia Fund, che è il long short Europa, che invito. Welcome Marc. Adesso noi switchiamo all'inglese, ma vi ricordo la possibilità di intervenire per le vostre domande. C'è infatti un numero che possiamo vedere qui, che è il 331-3204-097. Segnatevelo adesso, perché poi passano alcune slide. 331-3204-097, perché io girerò le vostre domande al gestore, a Marc Chapman. So, welcome Marc, thanks for being with us today again. Now, we will focus more on, your views and your strategy in 2017, but we have to start from 2016 and how the fund performed and what did happen to the fund in 2016.
So in 2016, the macro environment was extremely difficult for stock picking funds. So as Elisabetta explained, there was various macro shocks which happened during the year, which were followed by counterintuitive reactions from the stock market, starting with the weakness in China and the oil price, then followed by Brexit, and then by the US election. All of these events caused aggressive repositioning of portfolios. Both hedge funds and long-only funds found themselves underweight key sectors at a point when they were turning, and so they had to cover quickly their underweight position. And this caused aggressive short covering and aggressive movements in certain parts of the market which had been underweight. And so dispersion among stocks was lower for 2016. And this created a more difficult, hostile environment for individual stock picking.
So what did you take it right and what did you take it wrong in this kind of environment last year?
So in terms of the strategy of the fund, it's mainly the performance of the individual names which determines how well the fund does. So although the environment was hostile, that's less significant than how the actual individual contributors performed during the year. So you can see from that slide the top three and bottom three performance during 2016. In particular, I would highlight that Technicolor was a weak contributor to performance in 2016. The year before, it performed well, but in 2016 there was some short-term operational problems to do with one particular division related to set-top boxes and connected home. And from conversations with the company, I believe that the demand will recover in time, and that the customers who have postponed orders during the second half of 2016 will actually return, and demand will start improving in the second half of 2017. Now the valuation has got to very low levels, but that's not so important in the short term. When the earnings trend is down, the stock prices normally go down. But at a point where the earnings invert and expectations start being met, then there can be extremely positive share price reactions very quickly. On the other hand, the positive performers came from three idiosyncratic names. So no themes or sectors at work, no style bias, no plays on China or recovery. Soitec is a technology company in France, which basically has a revolutionary wafer technology called FD-SOI. which has been in development for 10 years. They did a rights issue in the middle of last year, and since then, the large technology players around the world have started to show more interest in their technology, and demand starting to accelerate, and the share price has performed very well since the middle of 2016. Entertainment One is a media company in the UK, manufactures films, TV content, and owns Peppa Pig. Had some short-term issues at the end of 2015 related to the growth in films. This has since been corrected, and there's been bid rumors around the company at the end of 2016, so that performed well. And then Technicas is an oil service company with a very long track record of delivering profitable growth on oil platforms, oil infrastructure, gas infrastructure. During the start of 2016, there was a short-term issue in Canada. They had a loss for the first time. That created a profit warning and a downgrade, and then that was a good opportunity to buy the shares, and subsequently they recovered during the year. So all of it, both the positive and the negative, was idiosyncratic. It was driven by the quality of the stock picking in our analysis that we did during that time.
Yeah, stock picking is at the very heart of your strategy, and let me ask you about the alpha generation of the fund in 2016, because in general, in the past, your hit ratio of stock picking has been extremely high, but in 2016, it was lower than the historic average. What was the impact on the alpha generation of the fund, and why was that?
Yeah, the hit ratio last year was lower than average, and I think it fluctuates through time, just like the goals from a striker in a football team fluctuates through games. Overall, through time, it works out well. But in 2016, the environment was more hostile. There was less dispersion. And also, some of the negative stocks that we had performed worse than we expected. And so the net effect of that was a slight drawdown during the year. Now, through time, the structure that we have, the careful bottom-up stock analysis, a thorough research process, and keeping open-minded and flexible has meant that we've been able to generate good alpha over the long term with a reasonably contained volatility based on a clear set framework which doesn't change through time. Even if the environment changes and sectors go in out of favor, people rotate out of value into growth and back again. All of these things go on, but beneath that, you can find interest in names with a lot of alpha potential by searching the universe on a qualitative basis for individual companies where they have a clear self-help case. So the earnings trajectory is driven by measures going on inside the company rather than by a macro factor. So we can see from this slide here that the correlation of the fund with various macro factors is minimal. So we check this from a risk management point of view to make sure that the fund inadvertently isn't correlated with something like the Hang Seng or the currencies. If you're doing stock picking, you could buy some German industrials, some German automotive, and find that inadvertently you have a correlation with the Asian stock market, which means that it's really a closet macro type fund. So we check that the fund really is idiosyncratic in that where the risk resides is in the stock picking, not in directionality. So any macro event that you could mention, we could test against this analysis and say the effect on the fund would probably be minimal. What wouldn't be minimal is the performance of the individual names within the fund. So the quality of the stock picking and how that varies determines how the fund performs. So the small drawdown last year was driven by a hit ratio slightly below average rather than any particular macro factor.
Well, one of the main factors for the people here in the room is volatility of the fund as well. So how did you contain volatility? And given the new environment and scenario for 2017, how are you going to manage volatility?
Volatility through time is between 6 and 7% for the fund. And essentially, the way it's contained is through a few measures. The first one is that we change our mind when we think we're wrong about something and we don't stick to something, which means usually we cut things before they go really wrong. It's not always the case, but a lot of the time, if we see a company and we think things are changing for the worse, we'll cut the position and exit quickly. The second thing is we have a trade and overlay. So a lot of these stocks are volatile. and they can be volatile for various reasons. Volatile around earnings announcements, around news flow, around sector rotation. All of these things create volatility. But we have a midterm target based on free cash flow, and we evaluate what position size to have in the stock based on the upside compared to our midterm target. So if volatility comes into a name, then we sell into the strength. If volatility comes out, we try and buy into the weakness. And the number of times we buy and sell can be very frequent if the name is volatile. And that enables us to build up a bank of profit, even if for the full year, the name might be flat in terms of performance. By being very active on the short term and taking advantage of volatility, we're able to extract some return from each name. And then in terms of the portfolio construction, we check that we're not too concentrated in one sector or one market, and that the correlation of the names with each other is below a certain level.
Now, you are already showing a chart on the European markets. What's your view on European markets in terms of valuation, in terms of earning perspective?
Okay, from a valuation perspective, the European market is on around 15 times price to earnings on forward 2017 earnings, which is attractive relative to most other asset classes. So 15 times earnings, 7% earnings yield is good compared to property, definitely good compared to the US market, and probably comparable to Asia. So from a relative point of view, Europe looks reasonably good in terms of valuation. Earnings expectations have been rising over the past 2 quarters based on reflation, which has helped the financial sector, and also based on continued good growth in Asia, which has helped the capital goods sector. So the cyclical parts of Europe have been performing quite well. And so analysts are now forecasting about 10% earnings growth for 2017, about 8% for 2018, which includes a reasonable recovery in the European markets. So the earnings expectations look okay currently.
Now, looking ahead, what do you see in terms of risk for Europe? We know that this year we have a political calendar which will be crucial. You know, election from Holland to France to Germany. Italy is on the verge and we don't know exactly what's going to happen, but the spread is widening a bit. So in terms of risks, what do you see especially for the fund?
There's a number of risks on the horizon, any of which could manifest themselves during the year. Obviously, all of the political ones you mentioned are foremost in investors' minds. Also, on the macro front, some negative news out of China could be bad. And just in terms of interest rates and the reaction of the market to the movement up in interest rates, in the first instance, it's positive because Europe has been near deflation for almost 5 years. Price and wages stagnating, the economy basically almost deflating, only saved by quantitative easing. So with a bit of inflation, the scenario of deflation has been reduced. So the probability of a deflationary environment has been reduced. In the first instance, that's positive. Now, if interest rates keep going up and commodity prices keep rising, then I think that stops a further rise in the equity market because the discount rate keeps on growing, and that effect is stronger than the earnings effect, and eventually there's a cap. So at a certain tipping point, I think a tightening environment will go from being a net positive to a net negative for the overall market. And this could happen in the US quite soon, and it could follow on in Europe in the second half. So various known political events, which we're all aware of, could become apparent. Usually the major risk is the one that's not known, that comes from nowhere. Like, I would highlight something out of China, stimulus out of China maybe abates a little bit, and that causes growth to slow, which hurts the capital goods sector of Europe and the capital goods in the US, and therefore earnings go into a downgrade cycle. So various factors create an even balance in terms of risk for the European equity market, I would say.
Now, we are seeing a chart on banks' earnings, and banks we know are really extremely sensitive to what happens in the political scenario. At the same time, the rising in bonds yields are already pricing in, and in fact, in the last Q of 2016, we saw price in the stock sector moving higher. What do you expect for 2017?
Okay, Okay, so the first point is that I don't analyse the market on a sector basis, so I don't really have vast, broad, aggregated views. But from what I understand, I think the re-rating of the financial sector is almost complete. Obviously, a lot of funds were underweight the sector. Hedge funds were short of Deutsche Bank, expecting a rights issue or some problem. And so those things not happening, plus the reflation environment, has created a positive environment for re-rating. Now, obviously, with the political arena showing more risk, and with a lot of them still being short of equity, it's possible that capital raisings could continue and that the short-term performance abates, I would say. But in terms of our portfolio and the earnings growth, I think our earnings growth is better underpinned than the overall market because it's underpinned by factors which I think are more in the hands of the company. So it can be either a growth business or a value business. But in both cases, I think that earnings estimates for the companies that we are long of are well underpinned by factors which are put in place by the management and which can't be so easily disturbed. I mean, in the end, if there's a huge shock, anything can be disturbed. But if there's general normal macro turbulence, then these businesses just continue as normal.
Now, you were mentioning that the European prices and valuations are more attractive than, for example, Wall Street, which is trading between 17, 18 in terms of PE. But at the same time, you know, the Trump effect, and Stefano showed, you know, how much the market since November went up in the US, continue to attract capital flows, important capital flows to American equity stocks. Do you think that this is going to continue in 2017, or do you expect in the end, because we heard in 2015 and 14 and 13 that European equities were cheaper than the US, but at the end of the year, US did better than Europe. What do you expect?
I think that the US economy is clearly more healthy than the European economy. And despite the change in political regime, it still looks more optimistic for the structural forces which drive the US economy. You'd expect their economic growth to continue to be good. And a little bit of inflation is actually positive. It's become a very consensual global long position to be long of the US equities. So in an environment where the central bank is starting to tighten interest rates, I would think the equity market in the US would start to struggle. Now, in terms of whether Europe outperforms it, that depends on whether the valuation argument is stronger than the earnings growth argument. And I think this year Europe could perform better based on a catch-up effect.
How about the M&A? We heard news about, you know, great operations since the beginning of the year. It looks like, you know, the market is picking up, and, you know, when big names step into the field, like, you know, Kraft Heinz on Unilever and so on, there's the expectation that something more is going to happen throughout the year. How do you expect the fund to participate or to benefit from M&A?
So each of the stocks that we pick on a fundamental basis, looking at the free cash flow opportunity over the next few years. So we never bet on an M&A environment helping us. But given that the environment is improving, and given that confidence is quite high among large corporates, there's certain parts of the portfolio where we'd expect there potentially to be interest from larger players in the sector. So Entertainment One, which was the company I mentioned from last year, provides good quality content for broadcasters. It makes TV production, which goes around the world. It distributes films. And this content is valuable. It's needed by all platforms to attract audiences. Like every marketplace, there's intense competition for audience share. And so the value of what they have could become more apparent this year and could attract some interest. And then in some of the niche healthcare companies we have, there's consolidation in the healthcare sector. We think they may attract interest. But all of the names stand up on their own without any speculation around being potential targets.
Now, the first question from the audience that I received is about the performance that you expect in 2017 in the case that there would be no systemic risk or no shocking events in politics and so on. What can they expect?
Okay, I think if we look at 2015 as an example of what can happen. In the first half of 2015, there was a lot of liquidity pushed into the market. And so all the short names that we had went up, but the long names did as well, but the NAV was overall left intact. So it wasn't a good environment. In the second half of 2015, when there wasn't much momentum, then the benefits of the stock picking become apparent. And so we finished the year more than plus 7%, based on the fact that the alpha generation becomes more apparent in a flat, volatile, or flat, stable environment. So if the market's trending aggressively, then the benefits of idiosyncratic stock picking become swamped by the costs of hedging. When the environment is more stable, flat, sideways, or flat and volatile, then the benefits of the stock picking become more apparent. So a return back to a more normalized return, like 2015, I think, would be what we should expect.
This is very interesting because you mentioned dispersion in performance and concentration. 2016 was a year of concentration. Are you confident that this year there would be more space for an active management and so more opportunities for you guys to bring alpha in the performance?
I think in terms of the big sector underweights, like resources and financials, I think those underweights have mainly been closed. And so in terms of aggressive sector rotation, I would expect to see less of that. In terms of style bias, the rotation out of growth into value has also been quite aggressive already, which means there's some good growth stocks in Europe which have derated back to reasonably attractive levels. But there might also be some good value names as well, so agnostic about value or growth. So these big themes have played out to some extent, which means that it's likely that dispersion between individual companies rises, and that creates, again, an environment which is better than 2016.
Well, if there are no more questions from the audience, I think we're done. Thank you so much, Marc. Thank you.